What is the 2-year Treasury yield? Have you ever wondered how the government borrows money and what that means for the economy? The 2-year Treasury yield is a key player in this process. It represents the interest rate the United States government pays to borrow money for a 2-year period through Treasury securities. This yield reflects the return that investors expect when they lend money to the government for that duration. Why is this important? The 2-year Treasury yield is a significant short-term interest rate indicator. It reacts quickly to changes in monetary policy and economic expectations. In a capitalist system, this yield serves as an essential economic signal. It is influenced by decisions made by the Federal Reserve, which is the central bank of the United States, and by market expectations regarding inflation and economic growth. When the yield rises, it usually indicates that investors expect higher interest rates or stronger economic growth. Conversely, when the yield falls, it often suggests that investors anticipate slower growth or a more relaxed monetary policy. This dynamic can directly impact borrowing costs for both businesses and consumers. The 2-year yield is part of a broader concept called the yield curve. This curve plots the yields of Treasury securities across various maturities. By comparing the 2-year yield to longer-term yields, such as the 10-year Treasury yield, investors and policymakers can assess current economic conditions. For instance, if the 2-year yield is higher than the 10-year yield, it may signal concerns about an upcoming recession. This information can influence investment decisions and how capital is allocated in a market-driven economy. The 2-year Treasury yield also plays a role in various financial markets. It affects mortgage rates, corporate borrowing costs, and the pricing of other fixed-income instruments. Investors often look to this yield to gauge the Federal Reserve's future policy moves and the overall health of the economy. In essence, the 2-year Treasury yield is a critical benchmark in the financial system of capitalism. It provides a glimpse into short-term economic trends, influences capital flows, and shapes investment and borrowing decisions. Its movements reflected the ongoing interaction between government borrowing needs, investor expectations, and monetary policy in a market economy. Understanding this yield can help you better navigate the economic landscape and make informed financial choices.